Jigar Mistry is with us of Buoyant Capital to take us through what he makes of things, what he makes of markets. Jigar, thanks very much. Great to have you back on the channel. Your first thoughts, Jigar, on what we are seeing out there. Very bullish broadly. I mean, actually, I should use the word buoyant. Is this going to go on? What's your view?
Hello, Prashant. Good morning. Thank you for inviting me again. I think there are clearly two schools of thought that are starting to emerge at this juncture. One is that, look, GDP loss globally is 4 trillion. You already have announcements to the tune of 11 trillion US dollars. And therefore, given the level of liquidity, you could have, markets staying more or less afloat or buoyant, as you put it. And you could have sector rotations and churns, which we have seen to a certain extent. Even last month when I was there in your channel, we seem to be looking at, IT pharma running up ahead, and then, some metals came in, and then something else, and now financials. So that sort of thing is something that is a school of thought. The other school of thought is, and that comes more from a fundamental backdrop, that you look at where India is at the moment. You look at PMIs in Europe and US come back to almost 97-98% of pre-COVID level, where the latest India numbers were not really that optimistic. Even the size of stimulus with regards to giving it out to the consumers was much lower. So the economic activity in India, be it retail opening, consumption, all of that has not really picked up to their previous highs. So one school of thought, the other school of thought essentially is that markets have moved up sharply. Once the COVID vaccine gets announced, you might see people sort of taking a pause and say, let's look where things fall. We think that it's becoming a little bit of a hot debate vis-a-vis where markets will settle at. What's more interesting is that there are several themes that are emerging within this, and that keeps us interested in a lot more names. So markets can take a pause, can take rotation, tech can slide back a little bit, but there are many interesting themes that are emerging, and we can get positioned based on what market is offering to us at the moment.
Jigar, I remember last time you were on the show, you highlighted a couple of ideas that you had in your portfolio. Any sort of fresh ones you've added? I put out a piece earlier this week on pharma and the kind of run that it's had, and basically just leaving viewers with food for thought in terms of whether a lot of the good news was in the price. But what are your thoughts there?
So pharma is interesting because one, it's coming from a multi-year sort of highs, and you've seen prices in the US, get cut by a large margin. That the rate at which the generic prices in the US are falling is reducing to a certain extent. Also, there's this technical factors where, because the funds were not positioned at all, you saw one bit of rise come through, and then there are follow-up buying that's happening. So I read your tweet on that issue, and I sort of agree with what you were suggesting, that incrementally the API sort of the PLI in API is not really that interesting. Most companies, if you hear on the call, are suggesting that they are not positively predisposed towards this sort of an arrangement. Compare that to say something like a mobile manufacturing. That was another stock we discussed last time. Dixon is one thing that we had bought month and a half back. And then, so there's a lot more optimism in areas where, India has some sort of a benefit. A semiconductor, for example, is not something that India has a benefit in. The API is the size of China, and matching their cost is virtually impossible. If not impossible, then it takes a number of years for us to go there. So you are right, you might not see huge fresh increases in the pharma sector. So we have some names in them, but not a huge weight per se.
Jigar, morning. Reema here. What about a company like an Ashok Leyland? Numbers were weak, but the commentary is upbeat, and the market seems to be betting on things normalizing towards the second half of this, financial year, and things pretty much looking up in FY22. Would you be in that camp, and therefore would you bet on these economy-facing stocks, whether it's in the auto names or whether it's even in the hotel and aviation stocks, which have been beaten down?
Good morning, Reema. So yes, one thing related to what Ashok Leyland CV cycle that's been been a little more difficult to sort of get a hold on. Even when the tractors volume are crossing the pre-COVID highs and 2 and 3 wheeler are catching up, the CV and the high CV, HCV is essentially one space which hasn't really seen a lot of pickup. And not just that, when you talk to financiers, most of them are suggesting that the highest morat or the highest sort of delinquencies in their business is coming from new and used MNHCVs. So, unless we see a huge sort of relief on that account, it is difficult to, they are completely sort of a pullback trades, and yes, they are not all that expensive, but there are a few other interesting names if you want to play this team. So, one thing essentially we are finding out based on our talks with a lot of these companies is that the unorganized sector seems to be hit even more now vis-a-vis, say, a demon time or a GST time. Especially in industries where they are looking at pretty high fixed costs and large capital bases, you are seeing, the unorganized players not being able to ramp back up as soon as large organized players have been. The biggest example there has been steel. So if you look at the large 3 or 4 steel companies in India, their production has been higher than all India production. And the reason why you saw a spate of price increases in India, which has been higher than global price increases, is because the unorganized market simply isn't been able to produce and get the product out in the market. So that is, that is something that as a theme is interesting. Hotels you mentioned is interesting. Both Lemon Tree and Chalet Hotels on their call suggested that, our fixed cost is so high, we are somehow managing to pull this through. But in the budget slash that space, you are seeing a lot of hotel closures that might not be able to ramp back up as quickly as we could. So that is an interesting space. Within this theme, I think the most interesting bet is media companies. Now, the easiest cost to cut was the ad spends. Most companies, if you see their quarter-on-quarter P&L numbers, ad spends have been slashed, without raising an eyelid. But when they cut their ad spends, we reckon that this will go predominantly towards the lower end of the channels, and the top 2 or 3 media businesses might not see as dramatic a fall as some of the other channels would see. And when you look at most of these media companies, the valuations are now, there have been issues, but the valuations are now in single digit P, and these are businesses that will survive given the lockdown. The subscription revenues for most of them, both Sun TV and Zee TV, has actually been very, very strong. So within this space, if you want to play a recovery theme where companies are still profitable, their existence don't really hinge on whether consumers might go back into a theater or a mall or not, then within the attractive zone, I think Zee TV and Sun TV, essentially we find a lot of space there.
Okay, Jigar, we'll leave it there. Thanks very much for joining us and running us through what you make of things and some ideas as well. I mean, the market is absolutely flat.